Okay. Bounced a trade idea off my firm. Same old lines. I mean, show me some technical indicators, proprietary research, something.
That's why I like Schwab. They help look out for your blind spots.
Come on, Johnny, you got this, buddy.
Speaking of blind spots.
It's time to trade up. Schwab helps you see the full picture with powerful intel and trading specialists who get it. Plus, get commission-free online stock, ETF, and options trades. Schwab, the better place for traders.
You know that tech stock we talked about? I picked up 500 shares.
You get in at a good price?
Oh, yeah.
Schwab saved you how much?
It's time to trade up to Schwab, where you get price improvement on 96% of orders and commission-free online trades.
I'll take care of this.
Are you getting complete price transparency? Expect more from your firm. Schwab, the better place for traders.
This is Charting the Markets.
Hello, everybody, and welcome to Schwab Live Daily. Our next topic today is our daily edition of Charting the Markets. My name is Lee Bull out here in California. I'm a trading services manager with Schwab, and with me today also here in Northern California is my friend, trading colleague, fellow chartered market technician and regional investment strategist for Northern California, Lou Mercer. Morning, Lou.
Good morning, Lee. Big Fed Decision Wednesday. Just for the record, no relation to Ray Mercer or the infamous song Louie Louie. Lee, I'll be manning the question box here today. We want to hear from you watching the show. You can type in your question just below the playing video. And we're going to challenge Lee today. With the city's reopening, can the markets continue to push higher? We see the NASDAQ just above 10,000 as we speak. We want to know, can gold get out of its trading range? Oil doubling over the last 2 months. Has it moved too far, too fast? All of this and more on Charting the Markets today.
Very good. All right. I'm going to have to dial it down with these written disclosures after that. Everything Lou and I talk about should be considered as educational and informational in nature only. Nothing's a recommendation. Any expressions of opinion that either of us make could change at any time based on market conditions. Lou, we look at a lot of charts here. That's why we have our clever name, Charting the Markets, but we don't recommend technical analysis by any means as your sole method of investment research.
That never gets old.
Yep. We look at ETFs at the end to review what's going on. If you're going to trade them, read a prospectus. We also look at futures contracts. If you're going to read those, read the risk disclosure document for futures and options. And with that, I'm going to show you all how to put up the heat map. We have questions on that, so every other time we show you actually how to do it. So just go over to schwab.com. And then we want to go to research, futures. Then we want to go to heat map. That's how you get it. All right, as you can see, NASDAQ is on a tear. Everything else, not quite so much. So let's start with the news. If I missed anything, Lou, just interrupt me and fill it in.
You got it. Thank you.
All right, so overseas, Chinese shares got a little pressure when we had the inflation figures over there came out. They were kind of weak. The industrial prices and like our PPI fell deeper into deflation, declining 3.7% year over year, while consumer inflation also declined 2.4%. Also, the futures were up and they went down a little bit overnight when the OECD, that is the Organization for Economic Cooperation and Development, said expects the world economy to contract by 6% this year. That's if we can avoid a second wave of the virus. The recovery will be slow, and they said the crisis will have a long-lasting effect. And in the U.S., they said they see GDP contracting 7.3% in 2020. If we do get a second outbreak, they say the hit to GDP will be closer to somewhere between 8.5% to 9% hit. And again, the futures sold off when that report came out, although they've come back since, obviously. Domestically, we've been watching the home builders, mortgage purchase applications continue to rip higher. We have now had applications for purchases increase 9.3% overall, while purchase applications increased 5.3%. So that we have now had purchase applications, Lou, have increased for 8 straight weeks in a row, which is a record.
Yeah, I was just at a Home Depot yesterday, and apparently I'm not the only one, as Home Depot is at an all-time high here and Lowe's right behind it. I definitely see why people were out and about shopping.
Yeah, that's for sure. Speaking of consumer activity, we also had the latest data from Open Table looking at restaurant reservations as a proxy for how the economy is progressing in the reopening process. Only one very small state actually had year-over-year increase, and that was where I used to live, Rhode Island. Next best performer was Arizona, and its reservations are down 37% year over year. Also, so they were the second best, but they're having right now the worst outbreak in the country of the virus at the moment. Hawaii, New York, and New Jersey reported still 0 reservations. So not going out everywhere, that's for sure. Turned into domestic stuff. Our CPI declined 0.1%. Consensus was looking for no change. Remember, it dropped 0.8% in April. Core CPI, which excludes food and energy, also declined 0.1% versus a consensus of it should have been flat. That was the 3rd straight monthly decline in core CPI. So the key takeaway here then is that if the Fed is inclined to raise rates because of inflation, obviously they're not going to do it. Speaking of the Fed, as you had said, Lou, the meeting is coming out at 2. The wild card will probably be the news conference, though, we were talking about earlier, right?
Yeah, news conference starts at 2:30 Eastern time today. So yeah, be careful. The market should move, or often does move, right when the announcement happens, but then the press conference can often whipsaw, take us the other way, or push us higher. So don't give up on your strategy yet. Make sure you have an exit strategy if you're a very short-term trader, because things could move quickly.
Yeah, so I got a couple of requests to review what I did yesterday, what the market maybe is looking for in the announcement and the news conference, so I thought I'd just review that again. So I think it's universally expected that they're not going to change rates at all or their QE program. But I think the key and what we should look for both in the statement and in the news conference is what type of forward guidance they are giving. Are they giving it more dovish or hawkish? So the expectation, you know, is we still have this almost permanent Fed put on the market, which has caused a rally off the March lows, obviously. If that is thrown in doubt at all, then you could see a pretty good pullback. Is it likely to happen? I don't think so. Probably not, though. But anyway, the other thing that people haven't been looking at for a while, but now they might, again, is the dot plot. Remember, that's where each member says where they see interest rates going out the next couple of years. And people look at the median dots where you get, you know, half number of dots above and below as their forecast. So that is how they set their forward guidance, okay? And here's why that is. So if the bank or a business knows that the Fed isn't going to raise rates for years, then they can plan. And banks know that their borrowing costs are going to stay low. So what the Fed signals with this dot plot is going to be important. So what happens here? What are the expectations then that I've been hearing about? No change to rates, QE, and the Fed says QE will continue in, quote, the amounts necessary. And the median dots that I just talked about show no rate hikes through 2022. All right, so that is what people are looking for. So it would be hawkish, which would be negative for the market if those median dots actually show a rate hike in 2022. There's probably not a chance that they're going to change their QE program, but if the dots go up in 2022, that's going to be taking as a bit hawkish. What would probably happen sector-wise is probably the market would probably sell off, but the financials would probably have relative outperformance because that would suggest a little bit higher rates. The dovish case, which would be good for the market, is if they introduce an interest rate cap or pledge where they say explicitly they will not raise rates, let's say until 2023 at the earliest, unless inflation goes above 2%, which we just saw with the CPI today. Ain't gonna happen, you know.
Mm-hmm.
So I think the rally would probably continue. What is the wild card to watch, though? The wild card to watch is if they come up with some formal QE plan. In other words, if they come in and they say, right now it's in the amounts necessary, right? But if they say, okay, the most we're going to do is, let's say, 500 billion over the next 6 months or something, that might be a negative. So the big question, just listen for, are they going to introduce a formal QE program to replace the quote as needed amounts? And then look at the dot plot. So I think that is kind of what to keep an eye on here. Okay. So with that, let us take a look at some of our commodities.
I got caught up looking at why they use the name dovish and hawkish. I always just remember that dovish starts with a D, so that means interest rates down. But I could not figure out where the terminology derived from.
Hawkish, I don't know, unless they soar higher, you know. Hawks do soar up there.
Oh, there you go.
Yeah. All right. So we're in a trading range in gold. So the uptrend has now changed to a sideways trend. So you're in a sideways trend, you can trade a range. Near-term resistance there is the, don't do that, thank you. So the 50-day moving average has actually stopped rallies the last 3 times it has tried. So that would be your signal that you're going back to the top of the range if we can start trading above that. Otherwise, you're looking at that range, 1675 on the downside. That should be good support. You'd have to change your opinion of this being neutral if that broke, I think. And do you see anything else on the gold chart here?
No, I just want to say that Goldman looks for gold to reach 1,800 per ounce on a 12-month basis. They also see tail risk of above target inflation as a potential driver for prices decline beyond 2,000. So, in my opinion, beautiful chart. We're just stalling out right now. We're in this range. You could enter on a pullback to that support line, or you could wait for a breakout. But many long-term investors even are owning a portion of their portfolio in gold as a hedge, and it's definitely worked this year.
Yep. Let's take a look at the ETF too, just for people that are trading that. Again, range bound, 157.
Yeah, look at that yellow line you drew. What was that, last week on our show?
Mm-hmm.
And just a couple days ago, it went down and retested that yellow line and held that support. So,
yep. So those levels that we put in there, other people are obviously seeing them. All right.
That's why Charting the Markets is the most popular show.
Yes, it is. All right. Let's take a look at silver. We saw that the gold-silver ratio has been normalizing. So now they had been outperforming for a while. Looks like we had a kind of a failed breakout of this little flag, but nonetheless, we've now devolved into a trading range on silver too. I think you got to look at 15.5 to 1722 is the current range there. You've got good support because you got the 200-day coincident with the lows from the flag there. So again, range bound on that as well. Now, Lou, I got a question for you. This is the doctor. Why do they call it Dr. Copper?
Oh, tricky. I think this has a PhD in economics. Quite often a tell as to where the market may go. But I'm kind of impressed here that we are approaching, if not taking out that previous high.
Yeah, that's the figure we said yesterday to keep an eye on, was that 265. And it wouldn't surprise me if we didn't go right through it. But you'd have to say we've got 3 days now over the 200. The only thing I can say here is the industrial metals are confirming this reopening narrative. Iron ore hit a high, all-time high, I believe, in Singapore overnight, too. Iron ore futures. We don't trade them here, but they trade them there. And so what this is confirming the reopening narrative. So what we are looking for, will we, if the market continues higher and this rolls over, that might be a shorter term tell, but we're not seeing that, right? We're just seeing confirmation here.
So far, you bet.
All righty. Let's take a look at oil. So we did have a build on the EIA data. It was kind of around the expectations, so oil didn't do much. Lou's going to give us some good sector action when we talk about sectors, about what's going on with like the energy stocks. That's coming up here in a second. But
yeah, these commodities, though, I like to just try to figure out which way they're trending, try not to overthink why. And in this case, oil is working. So a trader might look at owning it, especially as we're in this gap area right now. If we would have ran up to the bottom of that gap and used it as a ceiling, then we might think otherwise. But at this point, we're in that gap. You would think it's going to continue to push higher as long as it does. And Lee has that 10-day simple moving average in yellow, which seems like it's holding.
That's right. That's right. So I think if you're trading that, that might be something to keep an eye on. All right. You wanted also to look at interest rates. So here's
this 10-year treasury chart is just so perfect right now, textbook perfect, as far as we were in that long range from April to just a couple of weeks, just about a week ago, and we finally broke through that. What is it? 0.77 on the 10-year.
Yeah.
Ran all the way up, tried to test 1%, and then quickly sold back off. So in a normal breakout, this is what you expect. You expect this triangle to retest and come back down to the previous resistance, which now might be support. So from a risk reward perspective, it makes a lot of sense that a trader might get bullish on interest rates or bearish on bond prices.
Right. And speaking of getting bearish on bond prices, we did have our trend following interest rate signal get out of a buy last week. So we have a little bit of a pop-up today, but yep.
And there's more and more talk about the Fed actually trying to control the yield curve, that's really going to be where the conversation goes on. Can they keep the short end of the curve low, let the longer end do what it wants to do?
Yeah.
And that's usually positive for the economy.
All right, let's move on to the market.
Hey, Lee, do you have an answer on the dot plot question? Is the dot plot an average of the numeric values or split 50-50? I thought it was the actual forecast from each Fed member.
Well, it is. Each dot is a Fed member, right? So people tend to look at the median dots. So that means the dot, where there's what level do you have half the dots above and half the dots below? That's the median. It's not an average. People look at the median dots, not the average dot. Okay. And you can just look at the plot and you can see it usually. Okay. And I believe, let me just, if you want to talk about that, I believe you can get the dot plot at the CME. Let me just, let's go to, let me do something here for everybody.
Ladies and gentlemen at home, this is not recommended, but this is why we love Lee. He takes the risk. Success or failure, we tried. But yeah, keep your questions coming just below the playing video. You could type your question in there, and we'll do our best to answer it today.
So there's a current dot plot. All right, so you can find it here. So the blue is the kind of the median value. You can see there's half the dots above and half the dots below, right? So there you go. All right, we'll see if this changes. You can watch it after they come out. It'll probably be updated tomorrow or maybe even today. But anyway, you can see the median is where you've got half above and half below. Okay, let us go. I'm gonna let you just talk about, I'm gonna just give you a naked chart on the SPX and then,
Yeah, something I found interesting here is I take a look at the Argus Market Movers report all the time, which is on the Schwab.com website under Research, Markets, and Reports, and it's the Argus Market Movers. We don't have to go there, but Lee, I just wanted to point out that they were short-term bearish and long-term neutral after this major sell-off going into March, and they finally just changed their mind and said, okay, intermediate and long-term, they are bullish. So from a technical level, this is a bear market rally, right? By definition, it's still a bear market rally until we break into a new high. But wow, what a bear market rally we've had. Anybody that thinks it has to turn around today, I would say you probably thought the same thing a week ago, a month ago. And when the trend is up, you want to own it. So from a technical perspective, quite strong here. Be careful fighting against something that's working like this. Have your exit strategy if you are, live to see another day. If you're bullish, you want to own this, and maybe you just drag a simple moving average as something to trade against.
yeah, you can look at the usual suspects. Shorter term traders would follow probably the 10-day there. And there you go. What I wanted to talk about here, though, a little bit is, as you know, it was all over the place that the NBER announced a recession, right?
Yep.
So, of course, that piqued my interest into what happens to the market after a recession is announced. Not when the recession started, but when they announce it. Okay, which was this, what, Monday, I think. Monday, yeah, I think it was Monday. And so just looking at data from 1979 to 2020, the next couple months were very choppy. For instance, 3 months out, the market was only up 40% of the time. However, a year later, it was up 80%. Now that makes a lot of sense to me because the market's forward looking, so they already rallied by the time they announced this recession. So I was just looking at the forward returns after that. So a little bit choppy for the next few months, but pretty much 80% of the time, a year later, the market was up. The only time that did not happen was in 2001.
And quite often, by the time it's announced, we're already out of it. It just hasn't been reported yet.
Yeah, and I also have, we're going to talk about this when we review sectors, but I also have what sectors and areas of the market do better or worse after that announcement. We'll talk about that. We'll also have some great sector stuff we're going to talk about here in the
And if you think about that conversation, a lot of people believe that the virus is temporary, but the acceptance of using technology is really the game changer. So how is that going to change different cities? We're already seeing that here in San Francisco, where people are moving out to the suburbs and less likely to stay downtown. We saw rents decrease in Northern California for the first time in a long, long time, and I think something like 10%. So on one side of the aisle, people are saying, hey, it's just temporary. People move back home. They did not renew their leases at those higher prices now, but they will come back. The other side saying, no, things are different now. People will be able to work from home in large numbers and will probably take their companies up on that offer more than they ever have been able to in the past. What does that do to inner cities? Well, it's going to be tough for city revenue. It's also going to be tough for the coffee shops on the block corners, the clothing retailers as well. So we should see a huge shift here, but I think most of this will happen early 21.
Excellent, excellent insight there. I also want to show you this chart. Boom! And it looks very busy. Let me just tell you what it is. So these are what we call the big four, right? The big four averages, the Dow Jones Industrials, the Russell, the S&P, and the NASDAQ. You can see that yesterday was the time when all four of them had retraced more than 75% of the decline, okay? Because we just hit it yesterday. So that begs the question, what happens after all four indices recover 75% of a decline from a 52-week high to a 52-week low? Again, quite choppy for the next few months, but 6 months later, the S&P was up 91% of the time. A year later, it was up 100% of the time. You did have quite a bit of choppiness, though, over the next couple of months. For instance, 2 months out, 1 month out, the market was up only 55% of the time. 2 weeks, it was only up 45%. And we talked about yesterday the option data. I'm suggesting that we might have a little bit of a pullback in here because sentiment is getting a little bit, on some measures anyway, kind of frothy. And we have this data as well. So I just thought I would share that with you. I mean, the other thing that I found very interesting, let me go to stock charts here.
And Lee, while you're pulling that up on the sentiment numbers, what I usually try to keep track of is what's called the BFI, the Best Friend Index. And when your best friends are reaching out to you asking for stock advice, should they be buying, that's usually a sign of a top. When they're calling you to panic sell, that's usually a sign of the bottom. And believe it or not, I had some friends reach out to me, but guess what? It was not on a diversified portfolio or buying the S&P. Multiple people asked me about Nikola, what is it?
Yeah.
Nikola, the electric
maker.
vehicle company that now surpassed the market cap of Ford, and it's really been in the news this week. So I just thought that was funny that people that never invested, never wanted to take the risk of investing, now they want to jump into the most speculative name out there this week. So
yeah, that's a little bit, again, that's a little bit of a topping signal. I also wanted to show you this. All right. This does not happen that often. This is going back 10 years. This is the 5-day moving average of the up volume percent of issues. It went over 80% yesterday. You can see that hasn't happened that often. So kind of interesting on what that means. What it means is, once again, kind of near-term choppiness, but usually longer-term positive. And we've talked about this up volume, right? I showed you on that we had 2 flashes of the Zweig Niners, they call, where 90% of the volume is on the up day. So we had it on Friday and Monday. You can see them there. So again, that leads to good long-term returns. It also leads to a little bit of choppiness in the short term. So a lot of the things that I'm seeing suggest maybe a little choppiness in here. Of course, the wild card is the Fed, today. But just looking at history, the market might be in for a little bit of a breather. Also, what I would say is that the sentiment is getting a little bit extreme. We talked about the options. We talked about the option sentiment before, I believe yesterday. Now we just got the latest sentiment data from Investors Intelligence on the newsletter writers, and they're getting up there too. The bulls got up to 56.9 now from 53.5. That is above the 55% level that often suggests at least a temporary pause. The last time we saw this many bulls was in January 20th. Now, generally, this signal evolves over a month because remember, it was February 19th that we actually popped. That was the high. The bulls are in mid-February, right before the decline. We're still at right around 55%. The rules that Investors Intelligence says if you get bulls above 55%, you're supposed to take some defensive measures, which they define as tight stops and maybe selling some of your larger winners, just a portion of those. If the bulls get above 60, which could happen maybe next week, then you got to prepare for a little bit more of a stronger pullback. The bears fell to 20.6 from 23.7. That pushed the bull bear difference to 36.3. Remember, the first caution sign is 35 on that. Over 40, you typically get a little bit more worried. In mid-February, we saw that go to 35.8. So we're actually above where we were in mid-February. So, yeah. So
Yeah,
again,
so the idea is by the time you get bullish and feel confident, well, guess what? It's because you've already seen the recovery and it's already been priced in.
that's right. How do you
Thought
define
process.
short and long-term in our choppiness comment? 1 to 2 months is short-term. We got another question. This has come up too from Emerald in California. We have lots of IPOs going out there that are going nuts, and a lot of them, yeah, that tends to also happen near a trading top also. Just think about 2000 and the late 1999. All
Yeah,
right,
just for the record, the number of IPOs now compared to 1999
It's
is
lower,
still
yeah.
teeny
Yeah.
tiny. I
Right.
think the number from 1999 was something like 486. Last year, we only had 159.
Good point there. All right, I'm going to turn it over to Lou, who had me build this chart, which is pretty cool.
So yeah, let's start year to date, if you don't mind.
Okay, year to date. Let me do that. So
This is a chart with overlays. So what we're looking at here is a 60-minute chart, and we're going to look at it from a year-to-date basis, and each color is a different ETF sector, one of the sector spiders. And Lee, let me ask you, what did the best coming out of the 2009 recession? Trick question, it's not an index. What were the big winners coming out of the last recession, 2009?
I don't know.
Beards and cheap beer. If you think about it, the unemployment beard was extremely popular, really taking off in 2008 there as people got unemployed and went for a new look. And they also moved over to PBR, right? The cheapest beer you could find. People were making manmosas, putting little OJ in their beer or little tomato juice.
Interesting.
And that was the big winner. So we'll see what makes it here. But if you look year to date, look at that yellow line on the very bottom. Huge underperformer in energy. And we saw energy really drop this year. And the winner there being technology on the very top. So I just want to point out those two from a year-to-date basis. But as we look at these sectors and the sector rotation in action, let's go ahead and take a look at the last 1 month. So over the last 1 month, really, we're looking at a different story here. We're looking at not only energy being one of the leaders, we're seeing industrials being one of the leaders up there on the top. And then even materials is up there. Who's the lagger? Well, the lagger, you see healthcare only up 1.87% over the last month. So in action, I love looking at this chart because it gets you to visualize which sectors have been working over different time periods. And a lot of times people get caught up on technology being the only thing that's working, and really we're seeing that not the case over the last month.
Good, and I want to, that's really cool that Lou had me build this chart. That's very interesting. And what I just want to add to his research, we talked about, what happens after they announce the business cycle peak. We talked about the market. So what sectors do well after that announcement? All right. Well, believe it or not. So let's look again, 1 week out. The one that did the best, but it was only up 60%, 80% of the time was energy. The next strongest ones were staples and industrials. Let's look at a month, though. A month. This just shows you what's already built in. A month, okay? Consumer discretionary was up 100% of the time. And the worst performer was communications and financials. So let's look at a year out, just for fun. A year after the announcement of the business cycle peak, okay, the weakest sector a year out was energy, and the strongest sector, there were several of them. Financials, staples, and consumer discretionary, for what it's worth.
Hmm.
Yeah.
And we're getting a pullback on financials today, but you can see that they're right up there on the top of this.
Yeah, so let's just look at some individual, let's just see what's moving today, and then we'll take a look at some charts.
Yeah, so someone had a question, can somebody at home actually build a similar chart? Yeah, you bet. In fact, I like to build that with exchange traded funds all the time. So if you're trying to look at the NASDAQ, you might look at not only the QQQ, but then you might overlay, let's say, the top 10 stocks in the Qs. So you can see who's really moving over different time periods. You can just use the overlay tool.
Right, and just as if you're trying to do this yourself, what I did, you have to have a chart to do it on. So I put in just the SPY, but I made it a line chart with a black. So you don't see the charted symbol. All you see is the overlays. So if you're trying to make this yourself, that is the way to do it. Okay. So what sectors do you want to really look at here for a second, Lou? And we'll just look at those in particular.
Well, let's take a look at energy. Let's see if today's sell-off is a reversal of the uptrend, or is it just a pullback? And many traders are looking at this as higher highs and higher lows. And we spiked up there, really got a little overextended a couple of days ago, and now this is just a normal pullback to more of a normal level. I would look at that 20-day simple moving average as possibly a point that a trader might consider entering. That's if it can get past that 10-day.
Yeah, I would say the first place you could take a little bit of a shot is right where I just put that blue line too, because you got
the previous gap. Yeah.
Yeah, you got and it's the it's the top of that gap too. So if that breaks and you're still bullish, then you could add it to 20, like you said too.
The thought process on energy is people were losing money for years in energy. And with that sell-off going into the March lows, the idea was that was your capitulation point. People finally gave up, threw in the towel on energy and said enough is enough. And usually that's what marks a bottom. So even though it's going up and there's not a lot of activity driving it so far, the real idea is just that it got all the weak hands out. And this is now new ownership.
All right, let's look at the financials. Again, it looks right now just like a pullback and something that broke out. Again, you've got a gap and a coincident moving average at the same place. So that might be a place if you wanted to buy into the dip, you could consider it. Okay.
Or find it here. Yes, healthcare is another one that. So yeah, let's take a look at healthcare, just because healthcare has been underperforming so much here recently.
Yeah, because it rallied first. That's all. I mean, it's near highs, and then we're having a little bit of a pause. So it depends on where in healthcare too. So let's take a look at the. Hang on. A little bit of a glitch.
Yeah, so while you're pulling that, let me see if we could answer some of these other questions. Somebody wants to know about Schwab sector views. So yes, healthcare is the only sector that Schwab has a longer term outperform rating on, with materials being the only sector that we have a longer term underperform on. everything else being a market perform. You could find that on the schwab.com website under research, markets, and then industries.
Yeah, so I think I got a little bit of a glitch here. Let me see if I can reload this.
I wonder if we can just finish off with the schwab.com.
Yeah, let's go to schwab.com. Let me take a look at that.
Yeah, somebody else has a question. Why does the market ignore that the unemployment report is wrong, underestimating unemployment by probably 25%? We hear this all the time, whether it's wrong or it's not wrong, or the data is manipulated or not. Don't worry about that. Just trade in the direction of the trend, trade in the direction of the way that the market is going would be one strategy. Just make sure you have an exit strategy for when it ends. Because unemployment is something that, remember, they get this wrong all the time, right? It's a monthly report, comes out on the first Monday of the month. And they often do revisions to the numbers that came out. Well, guess what? The market really doesn't care about the revisions. I've learned that lesson the hard way. You might be right, but who cares? The market's already continued to move against you.
Yeah, I am pretty much shut down here, Lou, on every application. So let's see it.
Yeah, let me go ahead and pull up my edge here. All right. So yeah, while I'm pulling this up, just keep in mind that we have an earnings of S&P 500 companies. We had Tiffany report earlier today, and then we have Adobe, the software company, reporting after the bell tomorrow. And then PVH is coming out tomorrow as well. So if somebody wants to take a look at the ETF Blackjack, let me see if I can share my screen, Lee. Would you mind if I took
Go ahead,
control
because,
here?
yes, I'm totally blocked now.
All right. So someone wanted to take a look at, I think it was Blackjack, is that right? BJK?
Yeah, the gaming, gambling stocks. Yeah.
Yeah, so here I'm going to make BJK nice and big. I can do this in a new tab. Here we go, BJK. So yeah, very similar story on all of these, right? Big sell-off, rally in. Let's go year to date. So I'm a big person of drawing trend lines. So I like to just come in here and draw some type of segment line or a trend line. And this might guesstimate where the pullback might occur. And then I would look at saying, okay, well, the trader might go ahead and enter into a position somewhere around that pullback. So here's something fun we could do. We could take a look at BJK and say, okay, well, what stocks are actually in this exchange traded fund? So we could come in here to the research button. Okay, let me try this again. We could come in here and research BJK, click on portfolio, and that will show us the top 10 stocks in this portfolio. Right, there you go. What's interesting about BJK here is that you see some of these are international companies, so outside of the US. So what I'm going to do here is say, okay, well, what about if I want to look at QQQ? We can see the top 10 stocks in the QQQ. On the right-hand side here, I'm going to type in QQQ. And then let's do that overlay that we learned and that Lee looked at earlier. So within QQQ, I'm going to go ahead and use the icon on the right-hand side for overlays. And then I'm just going to type in overlays, Microsoft, enter, Apple, enter, Amazon, enter, right? You see what we're doing here? And what's great about this is you can now look at, wow, can you believe that NVIDIA is one of the top 10 biggest companies in the NASDAQ? And then we mentioned Adobe coming out with earnings. So even though this looks a little messy, you can see year to date, including the percentage increases right up the top. So year to date, look at that. NVIDIA outperformer up 56%. Intel, a lagger down here, only up 5%. Right, so real easy to see. Cisco down here in blue, negative for the year. And then Adobe up 22% here in gray. So quick, easy way for you to kind of build what we looked at earlier on how you can see the different sectors. Hey everyone, don't forget it's Lee's birthday month here in June. Thanks for joining us today. Sorry about the technical issues. We'll try to get those repaired, and I'll be back at the top of the hour to discuss exchange traded funds and how somebody can strategically use them in today's market. Thanks for joining us, and once again, we apologize for the technical issues we had. We'll try to get those fixed. Thanks, Lee.